Welcome back. As promised, we'll be taking a look at indirect taxes, as well as a minimum figure of how much Bob would be paying in indirect taxes and taxes overall. So while we see and experience direct taxes clearly in filing returns and in Trinidad and Tobago, listed on our pay sheets, we don't often take into account how much is spent on indirect taxes. All Trinbagonians going about their day-to-day lives will be paying some form of indirect tax on some of their activities and consumption. The most common and clear indirect tax in place is the value-added tax, which, in Trinidad and Tobago, applies on goods that are imported as well as goods and services provided on commercial supply within the nation. That is, items that are sold in general, not just to the final consumers, but also businesses. The actual payment of the tax and responsibility for accounting for it lays with the registered businesses rather than the consumer, but the burden, the actual cash to cover it, is shifted to the consumer through the price paid for the items and services. For now, we can avoid the details of how it works. We could go over it in a later video. The local VAT is levied at a rate of 12.5% on items not included in the schedules accompanying the VAT Act. These schedules specify the items and services that are exempt or zero rated. Included are essential food items such as rice, milk, bread, and baby formulas, some agricultural goods, utilities, and medicinal products, among others more recently exempted, such as electric vehicles and computer hardware, software, and peripherals. Exempt services include rent, medical and financial services, public transport, approved training and education services, among others. So let's calculate Bob's VAT bill, which we'd use to determine a rough minimum of how much of his gross income is paid in taxes. After paying his mortgage with his net income, we are left with $138,886. At this point, we would include a stamp duty payment, which is a tax paid on property purchases as a percentage of the valuation. But since Bob is a first-time homeowner and the house is valued at less than $2 million, he pays a 0% stamp duty. Moving along, we can use Bob's net income as the income he manages. At this point, Bob would also pay off other debts. Otherwise, we'll see him put away some savings. According to the 2008 Household Budgetary Survey, there was a savings rate of about 25% based on the difference between average household income and expenditure. So Bob puts away 25% of his manageable income. And he's left with $104,164 as disposable income. Also, according to the 2008 Household Budgetary Survey, the average Trinbagonian spent 53.6% of their income on essential goods, which aren't subject to VAT. So Bob probably spends 47.4% of his income on non-essentials, which are taxed, racking up a bill of $49,374. To find a minimum of how much of this is paid towards indirect taxes, we'll use the VAT figure of 12.5%, giving us a VAT bill of $6,172. This amount is the absolute minimum Bob would be spending in indirect taxes, as, aside from VAT, there are other taxes, such as the financial services tax, the hotel accommodation tax, the insurance premium tax, the online purchase tax, and the environmental tire tax. Lastly, let's see how much of Bob's gross income goes in taxes. Adding together his annual income tax, NIS, and health surcharge payment, and his VAT bill, we get a total of $50,886 being contributed in taxes, which is roughly 18.5% of his gross income of $275,400. Meaning that at minimum, any Trinbagonian in a middle income situation would contribute at least 18.5% of their gross income in all taxes. As we've seen, Trinidad and Tobago has in place a tax regime which, like all others, feature direct and indirect taxes. But the tax regime is not and can never be final. In future videos related to Trinidad and Tobago, we'll go in depth into the VAT regime and the incoming property tax regime. So make sure to subscribe. Thanks for watching.